Hi and welcome. You're listening to the X22 Report. My name is Dave and this is episode 1115A and today's date is October 31st, 2016 and the title of the episode is 3 Indicators Reveal that the Economy is About to Enter Crisis Mode. Now, before I get started, I just want to make an announcement for those people who are celebrating Halloween. Happy Halloween. And I'll be uploading a new interview on Tuesday, November 1st. It is with Jim Willey. He breaks down the transition, what we can expect. If you are on the X22 Report email alert system, I will send you an email alert letting you know the video is up. If you subscribe to YouTube, YouTube should send you an email. If not, you can go right over to the X22 Report Spotlight YouTube channel and you can see the video there. Or you can come over to the x22report.com site, scroll down a little bit, you'll see the video on the right-hand side, or you can go to newssentinel.com. Same thing, scroll down a little bit, look over to your right-hand side, and you can view the video there. Let's get into the economic collapse financial news. Now, as we can see today, the market is down a little bit, and if you notice, the market really hasn't been making many moves leading up to this election. It's been pretty darn steady. It might be down a little bit, might be a little bit up, but really we haven't seen any big moves. And we can see right now they're keeping everything on solid ground. They don't want anything to happen during this period. And we know for a fact that this economy that we're in, well, it's continually collapsing. It's deteriorating, it's declining, and we're starting to see more corporations, more retail stores, well, they're taking a hit. We see the Performance Sports Group, the maker of Bauer ice hockey equipment, and Easton baseball and softball gear. They have filed for bankruptcy protection. And we can see right now, Sports Authority, Performance Sports Group, we can see Aeropostale, and many other retailers, they are filing bankruptcy. And the reason for all of this is because the weakening of consumer demand. Now, many people say, well, people don't want to play ice hockey anymore. People don't want to buy clothing. No, what is happening right now is people do not have the discretionary funds to go out and purchase these goods. This is why we're seeing it happen to so many businesses. Now, I can understand if there were certain products in a certain store and they were very expensive and this was the only store that it happened to. Yes, you can make the case that, hey, people just aren't interested. The demand for this type of product is not there anymore. But we're seeing it with clothing. We're seeing it with shoes. We're seeing it with sporting goods. We're seeing it with many different things, with people going out to eat. And this shows us this has nothing to do with what people want. It's what people can afford. And we can see right now that as we move forward, that things are really starting to deteriorate quite quickly. Now, the powers that be, the neocons, the elites, the globalists, the central banks, they can continually keep the illusion alive. Of course they can. But we're not looking at the manipulated indicators that they use. We're looking at the other economic indicators where they have a very tough time manipulating. And all you have to do is go to the street and you can see that, wow, that store just closed. Oh, that store just closed. And if you start to talk to people, you realize that business is not doing as good as they make it out to be. Things are rapidly deteriorating. We see real disposable income per capita slides for the second straight month. And personal income rose less than expected in September. It was a 0.3% versus a 0.4% expectation. And thanks to a downward revision in August, spending rose more than expected, a 0.5% versus a 0.4%. And we can see that they continually revise these numbers. They manipulate these numbers to get the numbers where they want, and they continually do this. And what we're actually looking at here, which is most notable, is the decline in real disposable income, which declined to $39,092 in September from 39,117 in July. And we are continually seeing this, where real disposable income is declining. And this is a major problem, because as income declines, people have less to spend. As the value of the dollar declines, we see prices go up. So you have a declining wage, prices going up, something has to break. And what that is people actually going out and spending the money on goods. And we're seeing it. We're seeing the restaurant performance index drop. We're seeing retail not looking good. We saw last year during the holiday season, it was one of the worst holiday seasons that we've had. And right after that, we saw many, many stores close. Well, we're seeing the same thing occur again. And it's not just going to go away. They just can't fix it. The central bank, the U.S. government, they don't have the ability just to create jobs. The Federal Reserve, the central banks, they don't have the ability to say, hey, you know what, we're going to put everyone to work. Yes, they can print currency and just pay everyone, but that's just a Band-Aid fix. That's not going to help. Yes, in the short run, people will feel better, but in the long run, it's all break down. It won't go anywhere, and people will get very upset, and the country will stop manufacturing. It just will not work. And we're seeing more indicators right now letting us know that the economy is deteriorating. The Chicago ISM index dips to 5 months low. It has dropped to 50.6. Now, when we're over 50, it tells us that the economy, the ISM, is expanding. We see expansion. And we're hovering around that 50 mark. It went below 50 during the Great Recession. Actually, prior to the Great Recession, it dipped below. We had this huge dead cat bounce that brought it back up to about 55, and then the whole thing just crashed. We've been bouncing around above and below 50 right now since the middle of about 2014. And we are on a downward trajectory once again, which tells us that this is about to break. And we're going to be heading downward just like we did in 2008. We see the Dallas Fed outlook. Well, it is not good either. It's another indicator. 22 months of contraction. I mean, in 2008 and 2009, we had 24 straight months. Here, we're in a recovery, and we're up to 22 months. This is not a recovery, people. This is a recession heading into a depression, heading into a collapse. I mean, production decline, capacity utilization tumble, new orders and average work rate contracted, wages are dropping. This is a recession that we are in. We are heading into a major collapse scenario. Now, the VIX is sending out a warning signal. And the VIX is a ticker symbol for the Chicago Board Options Exchange. It's the volatility index, which shows the market's expectations of 30-day volatility. And when we look at this, we can see that we are heading down a path where we were back in August of 19th of 2015, where all of a sudden the market dropped and the VIX shot up, showing people are very nervous and afraid. Well, we're almost at that point once again. We are also seeing three major indicators letting us know there are major problems. The globally bond yields are spiking. With bond yields rising, earning yields will follow. The only way for earning yields to rise is for stock prices to fall. Long bond lead stocks to the upside this year, well, they're now leading down. The market is being held up by just 5 to 6 stocks. The number of individual companies above their 50-day moving average has been in a virtual freefall since February. Just a handful of companies remain kind of strong. Everything else is breaking down. They're becoming weaker. And we can see right now that as this continually happens, this market, the economy, and everything else is heading into a crisis mode. Now, the third indicator shows us that we have major problems here because earnings have already collapsed right now to 2012 levels. So stocks would need to crash over 25% to below 1,500 just to catch up. So bond yields are spiking, stock internals in a free fall, earnings, well, they're in severe collapse mode here. And you know what's very interesting? We saw this before. This is nothing new. We saw this back in 2008. And it's really starting to look like 2008 once again. And we can see right now from all the economic indicators, from everything that we look at, we can see that the economy, guess what? It's being propped up. They're trying to hold it together because this is prepared and ready to collapse. Now, again, they want to collapse this on their own terms. They want everything in place. And we can see we're coming up to the elections. And depending on what happens here, that's going to depend on when they bring the economy down. Because when we look out into the Middle East, the petrodollar, we see that is under threat right now. They realize that they're stuck. They can't push the debt any further. The petrodollar is doomed. And once the petrodollar is doomed, guess what? The dollar is doomed. If the dollar is doomed, guess what? The economy is doomed. So, most likely, during or after the elections, we will get more indicators. Now, I'm not predicting when this is going to happen, but we are looking at different indicators, different signs to let us know when this is happening. But for us, we've been preparing for this all along. And if you haven't been preparing, you need to do it now. You need to buy the food. You need to buy the water. You need to buy the medical supplies. You need to buy a weapon to protect yourself. You need to have gold and silver on hand. You need to have cash on hand. You need to be ready for what is coming. And I equate this to a hurricane or a storm that is coming, where it's offshore. You can see it. People are scrambling to get their supplies. People are warning that a storm is coming, because everyone's concerned about your safety, and people are prepared for it. They hunker down. Well, we have a storm coming. It's not to scare. It's not to put fear in you. It's to help. It's to get you prepared enough to weather this storm, to protect your assets, to protect your family, to protect what you have. I mean, prior to 2008, many people didn't know that this whole system was crashing. Everyone believed that everything was fine, where real estate will continually rise. Companies will continue to hire. Pensions were okay. No one would lose money in the stock market because it's at all-time highs. And then we come to find out all of it was a lie. Same thing now. This time it's much, much worse. This time they've been lying for 8 straight years, tricking us into believing that they created an economy that recovered, which it never did. Because we're looking at the economic indicators. We're looking at what's really happening here, and they make no sense when you compare to what they're trying to tell us. They're trying to tell us that the stock market is at all-time highs. Actually, do you know the stock market always hits all-time highs right before there's a crash? 1929, 2001, 2008, and now. And we're going to see this once again. And this is why you need to get prepared for what is coming. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.